So you're going to see, we've all, the four of us as traders, we've all been in situations where we've seen implied volatility change intraday dramatically based off of, a rumor or some news coming out. And implied volatility will change sometimes without the stock moving at all. We've seen that happen where the stock is sitting there and all of a sudden there becomes interest, and whether there's buyers coming in and we'll start to see the options get more expensive, or we'll see sellers come in and we see the options start to reduce in price. But generally, that option, that implied volatility, is kind of an indicator of what could happen in the future. And as all of us trading, it's important for us to understand what that implied volatility number means and how we can utilize that information to make smarter trades. So while an option's implied volatility returns to its underlying stock when the historical volatility levels, right? So will an option's implied volatility return to its underlying stock's historical volatility levels? Not necessarily true. And it's not necessarily a bet that you really want to take, that it's going to like go down. I mean, we've all traded long enough where we know the stock has gone down and we think that it's a good time to buy it, and guess what? It goes down further. So, as an indicator of when to purchase, it's very difficult. We just have to make, decisions based off of the tools that we have. Those assumptions don't always work, but at least we're using tools to make the best decision at that time. Now, why be concerned about implied volatility? Well, the biggest indicator is how expensive those options get. And we've all been in situations where we've purchased an option and the stock does everything we want it to do, and we don't make as much money as we thought we would have. And the reason is likely because implied volatility, the options were very expensive. And when the news comes out, what happens? The price of the options, they come down in price. So our expectations are not met. We may have made a little bit of money, but it didn't meet the expectations that we had expected because implied volatility had changed. So implied volatility, this is an interesting piece of implied volatility, and that is when implied volatility goes up, both the calls and the puts go up in price. And when implied volatility decreases, both the calls and puts go down in price. And there's all kinds of factors for why that happens. But basically, calls and puts have a relationship. The price of a call and a put have a relationship. If the price of a call is going up, which really means that extrinsic value of that option is going up, and if the call extrinsic value is going up, that means the put extrinsic value, which whether or not how much they're in the call is in the money, it has that implicit value, but it also has the extrinsic value, which is what implied volatility affects. And the put, on the other hand, if it's not in the money, it's going to be fully that extrinsic value. So as both of those options go up in price, I would expect both, as the volatility goes up, you would expect both the calls and the puts to go up. And the reverse is true if the stock is going down. So interpreting implied volatility. So this graph right here, I took this right off of our website. If you wanted to go and look at our implied volatility charts, I used one The stock A has a lower volatility. You can see that the range here, it's probably hard to see, but on the left here, you can see that the range is, 7 to 12, right? So we have a volatility that is 7.5 to 12 at the highest.